April 25th, 2022. San Francisco. Elon Musk agrees to buy Twitter for $54.20 a share. The price is about $44 billion in cash. At that moment, the deal looks simple. But the months that follow turn a corporate acquisition into a battle over money, information, and control. Musk had already become one of Twitter's largest shareholders. In early April, his stake became public, and Twitter offered him a seat on its board. He declined. Instead, on April 13th, Musk proposed buying the entire company for $54.20 per share. Twitter's board then negotiated with him, and 12 days later, the agreement was signed. The price represented a substantial premium to Twitter's market price before Musk's investment became public. For Twitter, the offer created a path to a certain cash payout. For Musk, it created something different: direct control of one of the world's most influential communication platforms. The financing was also unusual in scale. Musk committed equity and arranged debt financing, with banks agreeing to provide billions in loans. Then, the market changed. Technology stocks fell. Twitter's share price moved far below the agreed purchase price. The difference made the deal increasingly expensive relative to the public market. By May, Musk began raising questions about Twitter's measurement of spam and fake accounts. Twitter maintained that fewer than 5% of its monetizable daily active users were false or spam accounts, based on its methodology. Musk argued that he needed more information before completing the purchase. Then the dispute became public. In July, Musk announced that he wanted to terminate the merger agreement, arguing that Twitter had failed to provide information he considered necessary and had made representations about its business that he disputed. Twitter rejected that position. The company sued Musk in Delaware to force him to complete the transaction. That lawsuit changed the balance of power. The agreement contained a $1 billion termination fee under specified circumstances. But Twitter was seeking something more important than a fee. It wanted the deal itself. The court process created a deadline, and the pressure on Musk increased. Behind the legal arguments was a simple financial problem. Walking away meant fighting a binding contract in court. Closing meant paying the agreed price for a company whose market value had fallen. Musk's position became harder to sustain as the trial approached. Then, in October, the story moved again. Musk reversed course and said he would proceed with the purchase, subject to receiving financing. On October 27, 2022, the merger closed. Twitter became a privately held company controlled through Musk's holding structure, and each eligible share was converted into the agreed $54.20 cash consideration. The $44 billion purchase was complete, but ownership was only the beginning. The financing left Twitter carrying roughly $13 billion in debt, creating a large financial burden for the newly private company. Musk then moved quickly to reshape the platform. Employees were laid off. Executives departed. The company was later rebranded as X. The acquisition also changed who controlled decisions about moderation, product direction, advertising, and the platform's future. What began as a public company takeover had become a personal bet on the future of social media. The deeper story is not simply that Musk bought Twitter for $44 billion. It is that a public dispute over spam accounts, financing, contract law, and a falling stock market nearly broke the deal before the same two sides returned to the original price. And when the transaction finally closed, Musk had not just purchased a company. He had acquired control of a global communications platform, along with the debt, risk, and consequences that came with it. The answer would unfold over the next several years. Advertising became a central pressure point because many major brands were important customers of Twitter, while Musk's changes to the platform altered the environment those advertisers were buying into. At the same time, the debt used to finance the acquisition remained a defining part of the business. Banks had committed about $13 billion of acquisition debt, and the loans became difficult to sell at their original value after the deal closed. That meant that the financial consequences extended beyond Musk and Twitter itself, reaching the banks that financed the purchase and the investors who ultimately held the debt. In that sense, the deal was never just a $44 billion check. It was a network of contracts, loans, equity commitments, and legal obligations tied to one decision made on April 25th, 2022. The decision survived a courtroom fight, a collapsing market, and Musk's own attempt to walk away. Twitter was only the beginning.